Hello class, today we're going to take a look at Chapter 7, Capital Gains and Other Sales of Property. Learning Objective 1, Terms and Tax Forms. And the first term we're going to take a look at is basis. When we dispose of a piece of property, we're going to need to know not just the receipts that are brought in, but also what is the total cost of that asset. How are we going to determine the gain or loss? How we determine that is going to be this concept called basis or adjusted basis, as we'll see. So the basis is going to include not just the cash we pay for the asset, but also any debt obligations that we incur along with it. So for example, if we pay $500 in cash and promise to pay $100 later, then we'd have a $600 basis in that piece of property. And also other property or services are going to be included in that acquisition of the asset. The second thing we're going to look at is going to be what type of basis is calculated if we transfer property from one individual to another individual. The first is going to be something called step-up basis. And here in an example, if we transfer by way of inheritance a piece of property, the heir that receives that property, the basis in the property would be the fair market value on the date of death. Now you could also have an alternate valuation date, but for our purposes, we're looking primarily at what is going to be that basis, and here it's going to be the fair market value of the property. In addition to stepped-up basis, the other type of transfer that we're going to look at is going to be something called transferred basis. And the example we have here is going to be that if we have a transfer incident to a divorce, we have one spouse transferring an asset to another spouse. The receiving spouse is going to have a basis in that property that is going to be the same basis as the transferor spouse had. So the basis is going to remain unchanged. And then the last calculation that we see here is assets transferred by gift, and we're going to see a little bit more in terms of how that breaks out later on in this slide deck. But the valuation listed here is going to be dependent upon whether the fair market value is less than or greater than the basis. And what that's essentially going to mean is that it's going to be a transferred basis. So it'll be the adjusted basis of the transferor, except for you can't transfer loss in its full amount potentially. That the loss is going to get mitigated if that's what's being transferred. And then for the adjusted basis, we're going to take a look at how we calculate that gain and loss. The first thing we're going to need to do to adjust the basis is going to be to account for any depreciation. So if we had that $600 basis that we started with, but had $200 that was depreciated over time, the adjusted basis would be $400. So if we sold the asset for $500, we would have a gain of $100. If we sold the $400 adjusted basis property for $300, then we'd have a $100 loss in that property. And then the nature of tax reporting for gains and losses, it's important to know, is going to be not the form of the asset, but the use. So we're going to be concerned not necessarily is the asset a truck, but so much is are you using that vehicle for farm use? Are you using it for a business? Are you using it for your home personal transportation? What is the actual use of the vehicle? So for the tax forms, we're going to have a Form 4797. It's going to be the sale of business property, and that's going to be used to report those gains and losses from sale or liquidation of business property. And then we're going to have Schedule D, which is going to be where we record the gains and losses for the sale of property held for investment, and that's going to flow into the 1040. And we're going to record those transactions from the gains and losses on those investment sales of the investment property on the Form 8949. Let's take a look at our first concept check. Concept check 1. A gain or loss on a sale is the difference between the cash received and the original cost of the asset. True or false? And that is going to be false, because the gain or loss is going to be the gain or loss on the sale is going to be the difference between the cash received and the adjusted basis of the asset. Concept check 2. The gain or loss on the sale of an asset used for investment or in a trade or business operation appears on the Form 4797. That is going to be false. Concept check 3. When the buyer assumes the seller's liability, the seller includes this amount in computing the amount realized from the sale. True or false? That's going to be true. An example here would be if a buyer purchases an asset for $400 plus takes on the $200 loan associated with that asset, the amount realized is going to be the 400 plus the 200, so $600 total. Learning objective 2, classifying assets. In the first classification we're going to look at here, an ordinary asset is going to be defined in terms of another classification here, a capital asset. So ordinary income property is going to be any asset that is not a capital asset. So we're going to take a look at what a capital asset is. Capital asset, section 1221, is going to be any asset used for personal purpose or investment. And there's going to be 8 exceptions to this definition. The 8 exceptions are going to be those assets that are mainly for sale for customers, so stock in trade or inventory. Property used in trade or business that's subject to depreciation, so depreciable property. A copyright, such as like literary, musical, or artistic composition. Accounts or notes receivable. Real property used in taxpayers' trade or business. Commodities, derivative financial instruments held by a dealer. Certain hedging transactions if they're entered into the normal course of trade or business. And supplies used or consumed by the taxpayer in an ordinary course of a trade. Section 1231, business asset, depreciable or non-depreciable property used in trade or business. And this is going to be held for more than a year. So any business asset disposed of within the year is going to be an ordinary income asset. And the reason why is because it's going to be disposed of within a year, so it's not going to be 1231 property. And then it's also depreciable property, so it's not going to be a capital asset. So it's going to be in that catch-all that's defined by other classifications. So it's going to be ordinary income property, and it's going to be taxed, therefore, at ordinary tax rates. Let's take a look at our second concept check. 1, inventory sold by a company ordinary sold by a company is an ordinary income asset that appears on Form 4797, sale of business assets, and this is going to be false. Number 2, a capital asset includes all the following except for A, taxpayer vacation home, B, inherited property, C, property used in trade or business, and D, stock portfolio. And the answer here is going to be C, property used in a trade or business. Number 3, an ordinary income asset is any short-term or long-term asset used in a business. And that is going to be false. Number 4, section 1221 asset is any asset held for investment, and that's going to be true. Number 5, section 1231 asset is any depreciable or non-depreciable property used in a trade or business and not considered an ordinary income asset, and that is going to be true. Learning objective 3, ordinary assets. Now, if we have business inventory or accounts receivable, which are going to be ordinary income assets, but they're sold outside of, that is not part of the normal course of business, this can produce an ordinary gain-loss situation. Similarly, if we have sale of business property held less than a year, we could have an ordinary gain or loss situation. It's important to know why is this important, and it's because those gains are going to be taxed at a regular rate as opposed to a preferential tax rate, and the losses are going to be fully deductible. So let's take a look at our concept check here. 1, when an ordinary asset is sold, the gain or loss is subject to the capital gain or loss tax treatment, and that's going to be false. We do not get the preferential rate, we're going to get the ordinary rate. And 2, why is the distinction between ordinary and capital so important? That's because the preferential tax rate treatment is for capital gains versus the ordinary gains. 3, ordinary gains or losses produced outside the normal course of business relate to the sale of business property held for less than 1 year or the sale of receivables, and that's going to be true. Learning objective 4, capital assets. So the tax treatment depends on the holding period of the asset as well. So if you hold an asset for less than a year or more than a year, it's going to impact whether or not that asset is going to get that preferential tax treatment. And specifically, those assets need to be held for more than 1 year to get the preferential tax treatment. There are a couple exceptions here. So property received through a gift or non-taxable exchange generally are going to have the same holding period as the transfer. So the same way we looked at basis, getting a transfer basis from the transferor, Here, we're going to get the transferor's holding period as well. And then property acquired through inheritance is always going to be considered long-term property, even if the heir receives property that was held less than a year. So those, what are those long-term capital gains rates for the preferential rates? And typically we're going to see 15% as the long-term capital gain rate. If you're below a certain income threshold, it may be 0% is what's going to get applied to those capital gain rates. And then if you're over a certain income threshold, 20% is what is going to be for those assets. We're also going to have a different rate for Section 1250 property. That's depreciable real property used in a trade or business, and that's going to be taxed at 25%. And we'll take a look at that breakdown a little later in the slide presentation. And we're also going to have a 28% rate associated with collectibles and gains on Section 1202, that is qualified small business stock property. Prior to applying these preferential rates, we're going to need to calculate the amount that's going to be subject to those rates. We're going to do this using the Schedule D. So we will first net all gains and losses that are going to be short-term gains or short-term losses to figure out what the net amount is going to be for that. And then we're going to net all long-term gains and losses on the Schedule D to figure out what the net amount of long-term gain or loss is going to be. And then it's going to be that resultant gain or loss is going to determine the deductibility of a loss and the tax rate that's going to be used, whether or not it's going to be a preferential rate or not. Let's take a look at our concept check. Concept check 1, the tax treatment of a capital gain or loss varies depending on all the following except for A, the holding period, B, the basis of the asset sold, C, the taxpayer's regular taxable income, and D, the netting of all gains and losses. Here, the answer is going to be B, the basis of the asset sold. The basis will be that adjusted basis and help determine the gain or loss, but it will not be determining whether or not the tax treatment is going to be applied. 2, if a property received has the same basis as the basis in the hands of the transferor, the holding period includes the holding period of the transferor, and that is going to be true. 3, the holding period of inherited property can be either short-term or long-term to the beneficiary. That's going to be false. Inherited property will always have long-term for the holding period. And then 4, the 3.8% surtax is charged on long-term capital gains only if a taxpayer is in the top tax bracket. And that is false. 5, for sales after 2017, what is the maximum capital gains rate for the following? A, collectible gains. That's going to be 28%. B, Section 1202 gains. That's going to be also 28%. C, unrecaptured Section 1250 gains. That is going to be that 25% rate. D, single taxpayer's regular taxable income is $425. Here, the capital gain rate would be 15%. E, married taxpayer's regular taxable income is $490,000. So here we've gone over the threshold, so 20% is going to be the capital gains rate for this situation. And then F, single taxpayer's regular taxable income is $38,598. Here we're below the threshold, so 0% is going to be the applicable capital gain rate. And then we can see those laid out respectively. Learning objective 5, section 1231, business asset.
When a business sells an ordinary asset, like inventory, it becomes a cost of goods sold and the income generated is ordinary. Capital assets, referred to as 1221 assets, may be assets held for investment purposes, such as stocks or bonds, and are taxed at a separate, usually lower rate when held longer than a year. Section 1231 assets are also held for longer than a year, but need to be used for in the trade or business. So think about manufacturing equipment or commercial building. Now these Section 1231 assets are netted before those tax rates are applied. So if a Section 1231 property was sold for a $200 gain and Section 1231 property was sold for a $200 loss, the company would have a zero net 1231 gain or loss. So no 1231 tax rate would need to be applied here. Now, the Section 1231 gain is taxed at a long-term capital gain, but is subject to recapture provisions based on the depreciation taken, and we're going to take a look at that as well. So, the net 1231 gains are going to receive that preferential tax rate treatment of a capital asset. The losses, though, unlike the 1221 losses, which are limited to $3,000 per year for applicability towards ordinary income, Section 1231 losses are going to be unlimited. Now, Section 1245 is going to be that recapture based on depreciation. It's going to be for personal trade or business property, which is a subset of 1231 property. So here, when we're thinking of 1231 property as manufacturing equipment or commercial building, when we're talking about Section 1245, the applicability of Section 1245 for depreciation recapture, we want to be thinking about that manufacturing piece of equipment is specifically what we're talking about here. And then the tax rate that is going to be applied is going to depend on the amount of recapture. So if we had a piece of equipment held for a year that was purchased as $1,000, which had a $1,000 basis, cost basis on it, and was sold for $1,200, that would be a $200 gain. If over the course of a span of time greater than a year, the company had taken depreciation out on that piece of equipment, let's say $200 of depreciation, to where the basis in the property is now $800. So the realized gain on the sale of the property would be $400, the $1,200 minus the Section 1245 would say that the $200 depreciation, which was used to offset ordinary gains, needs to be taxed at that ordinary rate from the amount from $800 to $1,000. The amount above $1,000 can still be taxed at that preferred capital gains rate, the difference between the $1,000 and the $1,200. Now, Section 1250 is similarly going to apply to commercial buildings when we're talking about our 1231 property. Now here, we're largely talking, if we're talking about straight line depreciation, we have a similar setup to where the amount, if the amount of commercial property cost $1,000 and we had a cost basis of $1,000 in the building, that the difference between that $1,000 and the $1,200 sale would be still 1231 gain and could be taxed at the capital rate. If we took a straight line depreciation of $200 over the span of time, the difference between $800 and the $1,200 would have a realized gain of $400 total. However, Section 1250 would apply for the amount between $800 and $1,000, citing that as 1250 depreciation recaptured. That, provided it was straight line depreciation, would permit a 25% to apply to that difference, with 1231 gain for the capital gains rate between $1,000 and $1,200. Where 1250 gets a little bit more nuanced is if accelerated depreciation had been used, then there's a third amount that's included in it, and that's going to be the difference between the straight line depreciation and the accelerated depreciation, and that amount is going to be taxed at an ordinary gain. But that, for all practical purposes, tends to be fairly uncommon, but it is important to note that the difference between that accelerated depreciation and then the straight line depreciation would be ordinary gains, but the 1250 still applies at 25% for even the straight line depreciation to the purchase of the cost basis that was initially in the property, and then the amount over that, if there is still a gain. In our example, from $1,000 to $1,200, can still be that 1231 capital rate. So let's take a look at a concept check. It says under Section 1231, gains receive preferential tax rate treatment, and that is correct, but it says here that the losses are limited to $3,000 per year, which is not correct. Losses on 1231 property are going to be unlimited, so this is false. Number two, the only pure 1231 asset is land used in a trade or business. Here, by pure they mean not depreciated, and then so that land would be not depreciated 1231 asset. So that is true. What is meant by the term depreciation recapture? And depreciation recapture is going to be the rules transform some or all of the 1231 gain into an ordinary gain. With respect to the 1240 section 1244, we looked at the difference between on equipment. The difference between the $800 and the $1,000 example would be an ordinary gain, and then the difference between the 1,000 and the 1,200 would be the preferred gain, or the preferential rate rather, for the capital gain. And then what is the difference between a 1245 asset and a 1250 asset? Here, the 1245 asset, we're thinking of manufacturing equipment with the depreciation amount being recaptured for an ordinary gain, with the amount above that cost still being taxed at a preferential rate for a capital gain. The 1250 asset, the difference between the accelerated depreciation and the straight line depreciation would still be an ordinary gain, but the important thing is that the difference between the straight line depreciation and then that cost is going to be at that 25%, and then the amount over the cost being the preferred rate or the capital gains rate. What is the difference between recapture and unrecaptured gain provision? So here the unrecaptured gain is going to be taxed at the maximum of 25% for the 1250 property for all straight line depreciation taken. Recaptured gains is taxed at the ordinary rate, so that's going to be the amount between the accelerated depreciation and the straight line depreciation.
Learning Objective 6, Special Types of Sales. And what we're going to look at here is a situation where a taxpayer may be selling stock within the tax year and needs to calculate what the basis of that stock being sold is in order to calculate the gain or loss. So if we're selling 100 shares of stock, however, looking back, we had at one point in the past purchased 100 shares of stock at one price, and then later on 200 shares of stock, the same stock, at a separate price, all prior to this sale. Is it the 100 shares purchased that we subsequently sold, or is it out of that 200 share purchase that we subsequently sold? And the methods used are either going to be specific identification, first in, first out, so similar to FIFO from financial accounting, or an averaging of the basis. So a mutual fund pools resources from various investors and purchase those shares and pull them into a portfolio. The Form 1099 DIV is going to get sent annually to those individual investors in the mutual fund, and it will record dividends and capital gains and distributions from the fund year. And the capital gains distributions are going to get reported on the Schedule D or directly onto the Form 1040 if the Schedule D is not recorded. And the methods we're using here, we've got those three methods to calculate the basis of shares in the mutual fund purchased throughout the period. So we're going to have first in, first out. It's going to assume the first share purchase is always going to be the first share sold. Specific identification is going to assume that the share sold can be identified with the specific purchase. So in the example from before, was that from the 100 share purchase or was it from the 200 share purchase? And then average basis is going to calculate the average shares purchased for the period and use an average to determine the cost basis sold. So it'll be in between the 100 share purchase and the 200 share purchase. Another situation we may run into is going to be a worthless security, and it's going to get treated as a loss on the sale and exchange of the capital asset from the last day of the taxable year. Now, it's important to know a declaration of bankruptcy is not sufficient to indicate that the stock is worthless. And it's also difficult to pinpoint exactly when the security does become worthless to determine the sale date for determining the holding. That is, determining whether it's going to be a long-term loss or a short-term loss. And then, as mentioned earlier on, we've got a breakdown for those sales of assets given to the gifts. And here we've got the fair market value less than the donor's adjusted basis at the time of the gift. We're going to use the donor's adjusted basis. So again, it's going to be that transfer basis. However, if the fair market value, we're going to use fair market value for a loss. And if it's between the selling prices, between the adjusted basis and the fair market value, then we're not going to have a gain or a loss. And similar to the mention above as far as transfer basis, if fair market value is greater or equal to donor's adjusted basis at the time of the gift, we're always going to use the donor's adjusted basis for the gain or loss. So here, the way it essentially breaks down is that we're going to have a rule. We're going to use transfer basis. We're going to use the donor's adjusted basis, which is going to be good for fair market value equal or greater. If fair market value is less than, then if it's a gain, we're still using transfer basis. However, if it's a loss, then what we're doing by using that fair market value is we're mitigating the loss for the transfer. So we're going to use fair market value, which is going to be a lower amount of the loss is what's going to get pushed onto the transferee, or passed on to the transferee rather. Now, the basis for beneficiaries is going to be step-up basis for inheritance. So it's going to be the fair market value at the date of death, and then there could also be an alternate valuation date potentially, but the important thing for our purposes is it's the step-up basis you're going to get, and that the holding period is always considered long-term. And the example we have here is that property is inherited with a basis of $3,000, is sold 6 months later for $4,000. Then the $1,000 gain is going to be considered long-term, even though it's within that year, even though it's six months, and it's going to qualify for that preferential tax treatment because it's a long-term gain. Let's take a look at our concept check here. Explain the 3 types of methods used to determine the basis of units in a mutual fund. So first in, first out is going to be the first shares purchased are going to be the first shares sold. Specific identification specifies exactly which units are going to be for sale from the fund. And then average basis is going to take the total cost basis from multiple purchases and divide the total units to get an average cost per unit. So our second concept check here, it is often difficult to pinpoint exactly when a security becomes worthless, so the loss on a worthless security is treated as occurring on the last day of the taxable year. That is true. The basis for property given as a gift is always the fair market value of the property at the time of the gift. That is false, and would say conversely that it's going to be the transfer basis rather than the fair market value, unless it's going to be for transferring for a loss, then we're going to mitigate that loss by using fair market value. And concept check 4 here, the tax treatment of gain on the sale of inherited property depends on the holding period of the deceased taxpayer, and that is false. We're going to have fair market value or a step-up basis, and we're also going to have a long-term holding period